Hello, everyone. First of all, we would like to welcome you to another WEFI talk. And today we're very, very happy to have Jessica Jeffers from University of Chicago Booth School of Business to talk about the risk and return of impact investing funds. And both of the co-authors, Tianshu and Kelly, are in the audience. And just a little bit of a ground rules. That is, we're going to have 40 minutes for Jessica, and we're going to have 15 minutes for discussants. Today, we're very happy to have Morten to give us the discussion. And yes, Morten, hello. And then we're also going to have 10 minutes after that for general Q&As, discussions, and so on. Given both of the co-authors are here, it's likely that they're going to answer some questions in the chat window as well. So feel free to ask some clarifying questions by raising your hand. But at the same time, also write down your questions. Therefore, we can have a record and the co-authors can interact with you. With that, Jess, the stage is yours. Welcome to WEFI.
Thanks very much, Song. And yeah, thanks very much for inviting our paper. So this is, like Song said, this is joint work with Tianshu, who's a PhD student at Yale, and Kelly, who is a PhD student at Booth, who will be on the market next year. So please fly her out. So part of our motivation for this work is that, as you may be aware, there are growing concerns over issues like climate change and inequality. And as those concerns grow, there's been increasing pressure to figure out whether and how finance can help be part of the solution. And as a testament to this, what we'll broadly define as sustainable investing assets are at over $30 trillion globally today. So a lot of this happens in public markets, but our focus today is going to be on private markets. We think that private markets are uniquely suited to tackling these issues for several reasons. One, they're dominant in early and growth stages, and two, investors have a lot more influence over companies in private markets than in public markets. So in private markets, this combination of financial and social returns often takes place in what are called impact investing funds. And impact funds have grown to represent over $700 billion in assets, but we know pretty little about them. So our question in this paper is, what is the risk and return of impact investing? And we think, to be clear on something, we think this is interesting whether or not impact funds, quote unquote, do better or do well. The fact is that a lot of investors are already participating in or interested in these kinds of strategies, and understanding the profile of these funds will inform us about what kind of future is likely for the space and who we can expect to see investing in these funds in the future. So we think this is also interesting. We think this is also interesting because it adds to a couple of debates in the literature that have to do with how you view the market. So there's a debate over returns where, on one hand, some argue that constrained strategies like impact investing have to have lower returns. That reflects kind of a faith in the standard assumptions that we make about perfect and complete markets and rational and informed investors. But on the other hand, you have recent work by Cole, Malecki, Mulders, and Reed, who argue that, in fact, these assumptions are violated. And in particular, they argue that capital markets are imperfectly integrated, and this can generate value for impact investing. And you could also think of other frictions like information barriers, investor biases, competition issues, and so on. And then there's also a debate over the risk properties of responsible investing. So there's an influential paper by Banzal, Wu, and Yaron, where they argue that socially responsible investing is a luxury good. It's very pro-cyclical. More recently, there's been work suggesting that environmental risk may be underpriced. And there's a working paper by Gibson and co-authors where they argue that ESG might actually reduce portfolio risk. So this obviously matters quite a bit for how strategies will fit into existing portfolios. And so far, that discussion has really been limited to public markets, and we're bringing it into private markets. So again, our research question is, what is the risk and return of impact investing? There are two main challenges to answering this question. One is that there really isn't much data on impact investing funds, so that's kind of a problem. And then even if we can get our hands on some data, there's the general issue that we have with private equity and venture capital, which is that we have these infrequent and highly skewed payoffs. So how we approach this is, first, we hand collect data on impact fund cash flows. And this stems from a collaboration between Booth, Wharton, and HBS. That's called the Impact Finance Research Consortium, or IFRC for short. We are up to 62 funds in the database, but for our analysis today, we're going to use 51 funds after a couple of filters. And the good news, especially for PhD students maybe who are on here, is that we do plan to share the data. It's still a work in progress, but that's the goal. So hopefully in maybe 1 or 2 years off, we'll be able to share that publicly. Once we have the data, the crux of our approach is that we use distortions in existing performance measures to back out information about the risk properties of these funds. So we build pretty heavily on work by Korteweg and Nagel, and their measure of performance, which is the generalized public market equivalent, which I'll talk about some more in a bit. And then we'll be using two benchmarks to contrast with our impact funds. One is the general universe of VC in the US, and the other is a more narrowly matched set of funds. And the two serve different purposes, and I'll explain how we use them when we get to that. So for a quick preview of our results, we find that impact underperforms the public market by 30 cents on the dollar, but outperforms VC by 15 cents. And when we compare to the more narrowly matched benchmark, we find roughly similar performance between impact and this more narrow benchmark. When it comes to risk, we find that impact investing has a substantially lower market beta than VC. The difference with the matched funds is smaller, but it's still consistent with a particularly low beta for impact. And then we can also think about other factors besides the market factor. When we add sustainability or a small growth factor to our model, we find similar performance estimates for impact. And interestingly, we find that a public sustainability factor does not explain impact returns. And our results suggest that you actually get very different exposure from investing in a public sustainability index relative to private market impact investing. So our paper contributes to the broader literature on sustainability. As I've mentioned, a lot of this literature has focused on public market strategies like ESG, and there are a variety of takes on how ESG performs and investors' tastes for quote unquote green strategies. There's a lot less on impact investing in private market funds just due to data limitations. Like I said, though, we think that this is a really important distinction, and that there's a very different potential for achieving sustainability through private markets relative to public markets. So just two papers that I want to highlight. I've already mentioned the one from Cole and co-authors, where they focus on one large fund and argue that imperfect integration of capital markets explain why that fund has outperformed the market historically. Barbara, Morse, and Yasuda also have a paper on investors' willingness to pay for impact, where they find underperformance for impact funds. The most important difference with us is that they don't have cash flows for their funds. So they look at IRRs and multiples. And our contribution relative to that is to look at the risk exposure of impact investing and then returns adjusted for that risk exposure. And we think that's pretty important because it informs these different views of the market that I mentioned earlier. And then, in fact, there's been some great work recently on the risk of private equity cash flows, which we build on pretty heavily. One thing that I like about our paper is that I think we're able to synthesize some of that work and develop an approach that you could easily think about transposing to other asset classes if you wanted to back out the relative risk profile of something else. Like I said, we get impact fund data from the IFRC. Prospective impact funds are sourced from a variety of places embedded as dual mission funds. We collect many types of data, including survey data, legal data, and financials. And actually using the legal data, we have another paper where we find that virtually all of these funds show commitment to impact in their contracts. In terms of who these funds are, they cross asset classes, though they're most similar to VC. We see investment across different regions and industries. And I'll skip that for now, but I'm happy to go into more detail if there are questions. We also have mostly first-time funds, but we have a fair number of follow-on funds as well. The financial data come from raw audited financial statements. We convert these into standardized cash flows, net of fees. Some impact funds are explicitly concessionary, meaning that they advertise upfront that they're going to target something below market returns. So for our purposes today, we're going to drop these concessionary funds. We're focused only on market rate seeking funds. And we also drop funds for which we have less than 3 years of data, or if we have significant gaps in the data. So we end up with 51 impact funds between 1999 and 2017. In terms of our benchmarks, we use funds from Preqin over the same time period. And like I said before, we're going to have 2 benchmarks that serve different purposes. So the first is the universe of VC funds in the US. The goal of that comparison is to put our results in the context of a well-known asset class. Impact, as I said before, doesn't fit exactly into any one asset class, but it does have the most overlap with VC. And with VC, we have a large sample size, so that comparison is a little bit more meaningful. The second benchmark is a set of funds that are matched more narrowly to our impact sample on asset class, vintage, and size. So that comparison is going to be a little bit noisier because we're going to have 2 small samples, but it helps to address characteristics that could influence the risk profile. And each impact fund gets matched to a different unique counterpart. So we end up with 51 impact funds and 51 matched funds. So some summary statistics briefly. So the full VC sample has a slightly earlier vintage than the impact sample. Obviously, when we match on vintage, so that goes away. Impact funds are pretty small as a group, and that's part of why we match on size, but even matched funds tend to be a little bit larger. In terms of absolute performance measures like multiples and IRRs, you would definitely conclude that impact is worse than its counterparts, kind of like that Barbara Morten-Yasuda paper. And one of our questions in this paper is understanding to what extent that reflects different risk or not. And the last thing that I want to highlight is that when we look at VC funds, partly because they're slightly earlier vintages, we do have more cash flows. When we match, we limit the counterpart to having the same number of years, so it's more apples to apples. Okay. So if there aren't any questions, I'll just keep going into the methodology that we use. So a classic measure of performance in the literature is the public market equivalent, which some of you may be familiar with. This was developed by Kaplan and Schoer in 2005. And the basic idea is this neat thought experiment where essentially if you take the cash flows that go into a fund and then cash flows that come out, how does that compare to what you would have gotten if you had instead put the same money into the public market and then drawn down at the same dates? And that's the basic gist of the PME. And what's really nice about this measure is that it doesn't require strong distributional assumptions, and it's pretty straightforward. And you can apply it to these irregular, skewed cash flows. But it does have its limits. And the biggest one is that it assumes this fixed equity premium and risk-free rate that can miss the reality pretty badly. And it also doesn't allow for getting confidence intervals around the estimate. So let me say a little bit more about this, because we're going to actually use this to our advantage. So the problem with PME is that in rising equity markets, which is where we've been for some time, it distorts performance for assets with a beta different from 1. If you think about it, high beta assets like VC, they amplify the movements of the market. So they're going to mechanically outperform when markets are rising. The PME ignores this, and as a result, it's going to overstate performance for high beta assets during these times. So this is the insight from Korteweg and Nagel in their 2016 JF. And they propose a generalized PME or GPME to adjust for this issue. So in a very sort of simplified way, what they do is that they use prices to back out the realized stochastic discount factor over the time period of interest. And then they use that SDF to discount the cash flows. So rather than assuming the gross return on the market as a discount rate like the PME does, they reflect the realized SDF. And this has the effect that in rising equity markets, they end up discounting more for high beta assets to reflect this mechanical issue that we talked about. So in their paper, they show that this distortion in the original PME can be pretty high for high beta assets, and that this distortion grows with beta. And so we're going to use this property, this distortion between the PME and the GPME, to back out the properties of risk exposure for the impact funds that we're interested in. So let me illustrate how this works, because I think pictures are always worth 1,000 words. We're going to start with an asset that has a high beta, and therefore in an environment with a high equity premium, the PME estimate is higher than the GPME estimate. So now you can imagine borrowing at the risk-free rate to double down on this asset, so levering up the strategy. And that's going to drive up your risk exposure and amplify the problem. So PME will overestimate even more, and GPME will correct that. So on the x-axis, here you have the leverage factor of the strategy, and as it goes up, the distance between the PME and the GPME grows. And you can also imagine lowering the leverage by selling some of the asset and borrowing at the risk-free rate. And that will lower your risk exposure and reduce the gap. And eventually the two might even cross, because PME also understates performance for low beta assets. So this distance between the two measures is what we'll refer to as the PME wedge. And we're going to use the fact that this increases as beta increases to learn something about beta. Okay, so in terms of implementing this, the first step is to estimate the realized SDF. I'm not going to go into all the details now, though I'm happy to answer questions. But we do confirm that we're in a period with a high equity premium, so this approach is relevant. And then once we have the SDF, we can compute the GPME and compare it to the PME. That's the gist of our approach. So if market risk spans our assets, then we should see that GPME is around 0. And in terms of our risk predictions, if beta is 1, then the PME and GPME should coincide. But if the asset has a high beta, then PME will overestimate performance relative to the GPME. And as we increase beta, that wedge should increase. So similarly, if the wedge is greater for the benchmark than for impact, then all else equal, that means that the risk exposure is larger for the benchmark than for our impact funds. So we're going to do this process for impact funds, VC funds, and matched funds, and compare the results across those three groups. Okay. All right, so then let me get into our results. So I'm going to first show the results for impact funds. The PME estimates that impact funds underperformed by 16 cents relative to the public market. The GPME estimates that impact funds underperform by 30 cents on the dollar relative to public market. And we can almost project 0 pricing errors with the GPME, though not quite. The p-value for the GPME is going to naturally be larger than that for the PME because it incorporates uncertainty about the SDF parameters. But what we take from this is that impact funds definitely underperform relative to the public market, even after adjusting for risk exposure. And the other thing that's worth noticing is that there's this gap between the PME and the GPME. So this positive wedge, as we just discussed, suggests that we have a beta that's greater than 1, although the two numbers aren't statistically different, so we can't actually be sure. We'll get into that more, but first let me compare that to our benchmarks. So I'll first start with the VC benchmark, and on the left here, I've kept the impact estimates for reference, but they're what I just showed you. And on the right now, you can see the performance estimates for VC funds. So when we look at PME, it's actually pretty close to the PME for impact. It's also negative. It's actually a little bit better at a 13-cent loss on the dollar. But when we adjust for risk exposure with the GPME, we see a substantially lower performance. We have a loss of 44 cents on the dollar. And so this sounds pretty bad for VC. It's actually consistent with recent work on VC performance since the 2000s. Others have noted that there's been pretty large underperformance by VCs. The other notable thing is that there's this very large wedge between PME and GPME for VC funds. It's actually twice the size of the wedge for impact. So again, this is consistent with a large beta for VC. So we'll dig into these more. Let me first show you the other benchmarks. So this is the smaller set of funds that were matched to impact funds on asset class, vintage, and size. So again, we've got the impact results for reference on the left, and on the right, we've got the results for our matched funds. And the PME estimate there is actually very close to 0. So without adjusting for risk exposure, you'd see that matched funds perform just fine. When you look at the GPME, they actually do have slightly better performance than both VC and impact funds. They lose only 21 cents. And we can't rule out that they perform just as well as the public market. That p-value is pretty large. The other thing that I want to highlight is that the wedge remains positive, so still indicating a positive beta. It's actually somewhere between the VC wedge and the impact wedge. So to narrow in on these differences, there are a couple things that we can do. The first is that we can create these long-short portfolios for each benchmark relative to impact funds. So starting with VC, we can create a portfolio that goes long $1 in VC and then short $1 in impact. So when we use the PME, this net portfolio does all right. It's kind of a wash. But when we use the GPME, there's a net loss of 15 cents on the dollar for this portfolio. And we can reject that VC performs as well as impact. So to kind of call back to where we started, for us, this points to potential frictions in private markets, since in principle, impact should be a more constrained strategy than VC. Though of course, both strategies are doing worse than public markets. And then the other thing just on this is that even this long-short strategy has a large wedge between PME and GPME. So this, it seems that VC has a much larger beta than impact, and we're going to come back to that in a bit. So we repeat the same thing with our matched funds. And this time we gain a little bit. So matched funds are doing a little bit better than impact funds. The difference is not statistically significant, though, at least when we adjust for risk exposure with the GPME. And now the PME and GPME estimates are much closer. So to get a better sense of this, we can use the artificial leverage strategy that we discussed earlier. So if you remember, we can do this exercise where we artificially lever up and down our strategies, and we re-estimate the wedge at each point. So the y-axis here shows the PME, GPME wedge, and the x-axis shows the leverage factor. And the dashed line here is the VC wedge, and you can see that it increases very rapidly as we lever up. So that corresponds to a starting beta that is quite large. The solid line is the impact wedge, and that stays actually pretty flat. It's increasing very, very slightly, but it's actually flatter than we expected. And that corresponds to a pretty low starting beta. So from comparing these two lines, the two wedges at every point, we can conclude that the beta for impact is substantially smaller than the beta for VC. We can then repeat this exercise with our matched funds, and now we've got a dotted line, and that wedge, that line is in between VC and impact. It's harder to distinguish, but it is it does seem to be higher than that for impact, and overall we conclude that market risk exposure for impact is pretty low. Let me talk a little bit about other factors. So, beyond market risk, we might care about covariance with other factors like a public sustainability factor, for example. And we can actually use the same logic to back out these covariances. So this PME to GPME distortion also applies to other factors. The key difference is that this will now depend on the market premium of whatever factor we're looking at. So in the case of the market, we have a high equity premium, and so we were looking for a positive wedge. But it is also possible to have a negative market premium, in which case we'd be looking for the opposite. So what we do is that we re-estimate an SDF with the Dow Jones Sustainability World Index as our single factor. And when we do that, we find that estimates that actually indicate a negative premium. So we're in the second case where we're going to be looking for a negative wedge to indicate a positive covariance. So these are results, and sorry, I know this slide is a little bit busy, so let me take this one at a time. So so on the left, we've got our impact funds and the PME and GPME. And so what this tells us is that impact funds lose 10 cents on the dollar after adjusting for the sustainability risk exposure. So that's the SI GPME. And our benchmarks instead tend to gain after adjusting for that sustainability, public sustainability factor. So what this tells us is that impact in private markets is not a profitable way to gain exposure to the public sustainability factor. I think that difference is kind of interesting. And we can also, again, compare our PME and GPME estimates, those wedges. In this slide, it's hard to infer because our estimates are pretty noisy, but we can use the leverage approach again. And so I think I have a little bit of time, so let me just show this graph. And so again, we're in the flip case from before, where because we have a negative premium for the sustainability index, if you see a negative slope, that indicates a positive covariance. And if you see a positive slope, that indicates a negative covariance. You just have to adjust for that. And if we look at this approach, we actually find a negative covariance with the public sustainability factor for VC, a positive covariance for impact funds, but actually an even greater positive covariance with the public sustainability factor for our set of matched funds. Okay, and then the last thing that I wanted to talk about is this, we can also augment our model and add a second factor. So we can add a small growth factor or a public sustainability factor. And these are just the results for our impact funds. Here, adding adding a small growth factor or sustainability factor doesn't really change our abnormal performance estimates. We still see underperformance relative to the public market on the order of 30 cents on the dollar. And then if we look at the results for our benchmarks, those are pretty stable too across the different specifications. Okay, so I think I have, how much time do I have left?
About 12, I think, 40, 7 minutes.
7 minutes, okay. So, so we have, additional analysis that, here's what I'm gonna do. I'm just gonna show you this slide, and then I'm gonna allocate extra time where you can tell me which, if you're interested in any additional analysis that we've done, you can tell me which you're most interested in. So we've also looked at the leverage approach with the long short portfolios. We do both value weighted and equal weighted long short portfolios. I could talk more about the estimation details for the SDF, or also talk more about the characteristics for our impact funds. So I'll just sort of leave this for a second and see if anyone has particular questions that they'd like me to answer.
Yes, could you show a little bit about the impact fund characteristics? I think
yeah, absolutely. Yeah. So let me start with the geographic focus of these funds. So the most common geographic focus is North and South America, but we also have a number that are focused on the Middle East and Africa, Asia and Pacific. So you can see that this is pretty broad, right? This crosses a lot of different areas. In terms of the industry focus, so what we've done here is we actually matched our funds to PitchBook. We were able to match, I think, not quite all of our funds, but I think 47 out of the 51 funds. And we did this because PitchBook has a really nice already industry classification for the deals. So this is showing the distribution of the deals that the funds in our sample undertake. This other, so we categorize these into the FAMA French 12 sectors. The other category is stuff like education, professional services. I'm trying to remember now, but there were environmental services in here as well. And some amount of like sustainable real estate. And then in money, you have a lot of microfinance. So that's what a lot of these deals are here. But you can also see that there's a pretty wide scope. And then this is the sequence number of our funds. So like I said, we've got mostly first-time funds, but we also have a decent number of follow-on funds, second and third-time funds. And I think the last, so this shows you the asset classes of our funds. And like I said, we have the most overlap with VC, but we do also have generalist equity funds, meaning that they invest across stages for the most part. And we've got a small number of other like mezzanine and real asset funds. So oh shoot, what I now need to skip back. My links were not super consistent. Okay, actually we can do this. Any other questions? Okay, then I will conclude. So what we do in this paper is we analyze the risk and return of impact investing. Adjusting for market risk exposure, we find that impact returns 30 cents less than the public market, or 30% less than the public market. Returns are comparable to matched funds, and they're higher than VC as an asset class. The covariance of impact investing with the market is relatively low. It seems to be substantially less cyclical than VC. So in terms of this, is sustainability a luxury good? At least in private markets, it does not seem to be the case. In fact, if you were to add it to a VC portfolio, you'd be hedging a little bit. And we think that this is an important step for thinking about who is able to invest in impact funds. And then finally, adding other factors does not change our performance estimates, and impact investing is distinct from a public market sustainability factor.
Perfect. Thank you very much, Jess. And we already see a lot of questions and answers at the chat. I'm sure that after Morten's discussion, we will continue our questions. And now it's the stage is Morten's. We're very happy to have Morten Sorensen from Talk School of Business from Dartmouth to give the discussion. Morten, go ahead.
Thank you very much. Thank you. Let me see if I can first see if I can share my screen. And I had a little bit of a technical issue earlier, so please let me know if you can see me and if you can hear me. Does this show?
Yep.
Yep. Wonderful. All right. So then you won't get. You can see my cursor. So then you won't get
Yes.
annotations. But
Yeah, it's not
this
full
is as good
screen,
as
but we
it
can
gets.
see the slides and so on.
Yeah, exactly. I need my teenage daughters to help me figure out technology these days. Anyways, it's a pleasure to be here. Thank you for inviting me to discuss this paper, The Risk and Return of Impact Investing Funds. I think Jessica did a great job presenting this paper, so I'm not going to spend a lot of time on the contents of and the result. Let me just summarize in the broad strokes what is in here. So I think I read this paper as having three substantial contributions. First, they compare the performance of impact and non-impact funds. This is clearly an important issue. Then they develop this new method for measuring, estimating the systematic risk and factor exposures of private equity and venture capital funds, which I think is an enormous contribution as well. And then they apply this new estimation approach to estimate the risk exposures of these private equity funds and compare these impact and non-impact funds. So I think these are the three contributions, and all three of these are great. I had some summary of the data and the results. I'm not going to spend a lot of time on this. There is this Impact Finance Research Consortium, which is a fantastic initiative. It's collecting data for venture capital, impact, and non-impact funds, and then comparing those to non-impact funds from the frequent sample. All of this is a great initiative. We heard this from Jessica. Summary of findings. Again, we heard most of this already. So adjusting for the risk, impact funds, they underperform. So it's costly to invest in impact funds. This is consistent with other results that have been found in the literature. I'm not going to spend a lot of time on this either. There's this result that impact funds appear to be much less sensitive to public market returns and have a lower beta than non-impact funds. So this is sort of my reading of the paper and the main contributions here. There's a lot to like. The impact investment debate is very relevant and timely. There is existing, especially in the context of private investors. I particularly like the paper that Jessica was referring to about the contracting of private investors in this context. I think that the new method for estimating the systematic risk exposures is very novel and intriguing. And I think that the results are just very provoking and inspiring. So there's a lot to like in this paper, and it's a very interesting paper to read. I don't have much to say about impact funds, and I don't have a lot of time here, so I'm going to leave sort of the whole impact fund debate aside, because I think this is not my competitive advantage. And I'm going to spend some of the rest of my time here on the method. And I think there are two methodological issues. One is relatively small, and one I think I am more concerned about. And the relative small one is about the representativeness of the frequent data and the small sample that we have here. And we know there can be some biases, and Jessica was alluding to that, and I think that's a concern. But I think they're also aware of this, and they mentioned that they're moving to the frequent data, so this is probably going to be resolved. I think where I'm going to spend most of the last 7 minutes I have is on the method and how that works, and whether we can really estimate these systematic risk factors by subtracting two performance measures. And sort of my approach to that question is that this sounds great, but it's one of those things that is almost too good to be true. And if I'm thinking about the existing literature that has tried to estimate beta, so this is the Cochrane paper and the Ang, Chen, Gutzman, Philippou, et cetera, they write down these tremendously complex econometric models with filtering and Markov chain Monte Carlo, and they get estimates that are all over the map. And then after that literature, they come here and say, forget about all that. You can just subtract two numbers and that'll give you the beta. So that sounds good, but it's one of those where I'm a little bit skeptical because it's almost too good to be true. So for the rest of my time here, I'm going to take a deep dive into the stochastic discount factors and Finance 101 more than you ever wanted to know about the methods underlying these models here. So data representative, let's leave that aside. You are aware of that. How does the method work? So this is where I'll spend my time. So this is, so as a sort of a warning, this is going to go deep into asset pricing and stochastic discount factors for the remaining 6 minutes that I have. So hold on, and this is how it goes. So just to sort of fix terminology, we use stochastic discount factors to price risky cash flows. So as terminology, we usually think of M as a state price, as an Arrow-Debreu price. We have this insight that the net present value, the value of a stream of cash flows, you can find that by summing up the cash flows multiplied by this state price or stochastic discount factor, and then take the expectation of that's how we define net present value. This is all very standard. There are 3 classical stochastic discount factors that we use in the literature. We use the CAPM, where the discount factor is linear in market returns, the PME log utility, where it's 1 over the return on the market, and then we have this generalized PME from Korteweg-Nagel, where they say, we need some more flexibility in this stochastic discount factor, so we add this A and this B. So this is a generalized way of the log utility stochastic discount factor. All right, fine. This, we all know that. So we can apply this insight to evaluating private equity performance. So we have sort of 3 different models here, the KS PME, the KN PME, and the KNG PME. So now it starts to get a little bit hairy. Kaplan and Shore defined the PME as the ratio of the sums of the distributions over the returns to the market and the contributions over the returns to the market. They interpreted that in sort of the context of these index comparison methods that go back to Long-Nichols. And that's why they had this idea that it only works when beta equals to 1. But when we reinterpret this in the context of stochastic discount factors, we can see this is really just evaluating the distributions and the contributions using the log utility stochastic discount factor. So the numerator converges to the present value of the distributions, and the denominator converges to the present value of the contributions. And if that ratio exceeds 1, then the value of the distributions is greater than the value of the contributions, and the present value is greater than 0, and this is profitable. This is how the Kaplan-Shore PME works. Now, Korteweg-Nagel did some statistics on that, and they found that it's inconvenient to work with this ratio, so they rewrote it as a difference instead, and say instead of dividing one by the other, let's just subtract. So we have the present value of distributions, subtract the present value of the contribution. Let's call that sort of a present value of these cash flows, and then we can work with that. So here, this is the KN PME we have here in the middle, and then they generalize the stochastic discount factor, and we have this generalized discount factor down here in the way to calculate the present values. Now I'm bringing this up because there's sort of 2 substantive point here that speaks to the analysis in the paper. The first is that they cite this quote from Kaplan and Shore that say that if private equity returns have a beta greater than 1, then PME will overstate the true risk-adjusted returns. And I think Jessica repeated that in the presentation. I think this quote is not true. So I think Kaplan-Shore is a great paper, but this particular point is not true, because we know that under these stochastic discount factors up here, they will correctly price these, the PME will correctly price cash flows regardless of what the riskiness of the cash flows is. So if you live in a log utility world, then the PME works. Also, there is a distinction between the Kaplan and Shore PME where they have a ratio and the Korteweg-Nagel PME where they have a difference. And the paper is not entirely clear on that difference. And that was a little concerning to me when I was reading that, because all the statistics they reported was for the Kaplan and Shore PME, but the formal results rely on the Korteweg-Nagel PME, and that's a little bit different. So let's just leave that there for now. All right, so let's move forward. So how can we evaluate risk in a log utility world? So if the real stochastic discount factor in the world is the log utility stochastic discount factor, so 1 over the return to the market, then this difference between the PME and the GPME, that cannot be a measure of beta. So this idea that the PME, GPME wedge can estimate beta is not true in a log utility world. We know this because in a log utility world, both the PME and the GPME are consistent measures of present values. So this difference goes to 0, always, regardless of what is the beta of the cash flow. So this method of comparing this difference here is not true in general. It doesn't work in a log utility world. Now, then you can argue we don't live in a log utility world, and that is certainly the case. So we have estimates of these A's and B's, this generalized stochastic discount factor. So it's plausible that this method could work in a stochastic discount factor that applies in the real world, which is different from the log utility one. So does that work? Does the PME, GPME wedge in the real world measure beta? Well, here we have to get into the details of the model. We assume log normality, sufficiently positive market returns. We assume this generalized PME stochastic discount factor from Korteweg-Nagel. Then we show that the difference in the log expected returns is increasing in beta. So this is this difference we get from Korteweg-Nagel. Then we so there's some intuition behind this, but I'll just, in the interest of time, just skip over that. But then the next problem we get to is that we don't observe the expected returns under the PME and the GPME. We know that the difference in these expected returns is increasing in beta, but we don't actually observe these expected returns. What we observe is the PME and the GPME instead. So the next step in this method here requires that the difference between the PME and the GPME is increasing in the difference in the expected returns implied by the GPME and the PME. Is that obviously an increasing function? Well, that's not clear either. Is this relationship between the PME and the GPME monotone in the expected returns? It's not clear. And I think the right intuition here is go back to the IRR intuition, where it's well known that if you compare two projects, the one with the higher present value can have the lower IRR. And what we have on the right-hand side here are sort of present value measures. And what we have on the left-hand side are return measures. And it's not clear that they vary one-to-one. One particular concern I have is that impact funds tend to be smaller. If they're smaller, then mechanically the present values are smaller. And then mechanically the difference between the PME and the GPME will be smaller as well, unrelated to the actual returns of these. And that would seem to look like they have a smaller beta in this analysis, even if that is not that is not true. All right, so let me take a step back. This was very fast and this was very messy, but I think that there are a couple of open questions about this method that I would like to know more about. I would like to know, how sensitive is the method to the specification of the true SDF? We know it doesn't hold under all SDFs. What are the requirements for the actual SDF for this to work? Under what restrictions on cash flows is this relationship between the PME and the GPME wedge increasing in the expected return? So that's not an obvious link either. Does this method extend to multiple priced risk factors? So Jessica was alluding to that at the end, but that's not obvious at all. Remember, we only have one difference to work with here. We have the difference between PME and GPME, and then we need that to identify a number of betas on the right-hand side. But if you only have one difference to work with, it's unclear how you can disentangle whether that difference comes from one or more betas. So I think that this is a very interesting method. I think it's a great idea and a great intuition. I think there's still some blanks along the way that we need to look at to understand how this really works in practice. All right, so this is all I had, and I'm sorry if this was a little bit into the weeds of stochastic discount factors and performance evaluation. It's a very interesting study of venture capital fund performance, comparing impact and non-impact funds, are very timely and relevant. Evaluating risk using this PME, GPME wedge is very novel and inspired. Concerns about sample selection, but I think the main concern I have is, does that method actually work? And I don't think the paper answers that question convincingly at the moment. Also, I think the formal exposition could be a little bit clearer, and we could get into more of these formal details to figure out what exactly is assumed in this methodology. But overall, very enjoyable and inspiring paper. And yeah, this is a great read. Thank you.
Thank you very much, Morten, and thank you for the discussion. So how about Jessica spend a few minutes responding to the discussant, and then maybe the co-author group can pick some of the old or new questions from the chat window to highlight. Jessica, stage is yours.
Yeah, thanks. Thanks so much, Morten, for the careful discussion. And actually, this works beautifully because I was wary of going into I did not go into the weeds in the presentation, and I'm glad that I was able to essentially outsource that to Morten. So thank you. And I wanted to be clear on one thing, which is that you say all of these other papers rely on complex econometric models, and this one just says like we can take a difference. To be clear, we are relying on the complex econometric models. We just are sort of building, like taking and largely Korteweg-Nagel, and we're saying let's take that as given and then build a small little thing on top of that. But that is in the background of what we're doing. We do have to go through that. So, your points are generally like really well taken. I think that we should be clearer in our exposition. So we can be clear that we do rely on the fact that we don't live in a log utility world. We should make that assumption clear up front. And we're using the Korteweg and Nagel PME, also definitely something we should state up front. The influence of size is something that I've noted, and I definitely want to work through that and check that that's how that could be affecting our estimates. And we have done a different we did do some robustness to checking different sizes, and that's part of what the match thing does too, right? We're matching on size, but I think it's a good idea to address that explicitly. I think sensitivity to different types of SDFs, we've actually done also some of that, but I think we took it out of the paper, so we can add that back in and do a more robust discussion of that. And then the last point I had noted was this extending the model to multiple factors. To be clear, we were not planning to extend to estimating multiple betas, or not even estimating, but to inferring different betas. We were just saying, look, we can compare the headline, abnormal performance number in multi-factor models. That's the extent to which we were using that. But yeah, let's maybe see if there are other questions. And thank you, Morten, for raising these important points.